Welcome to the June Market Outlook from Principal Wealth. I am Julina Ogilvie, partner and wealth advisor, joined by Bob Paolucci, our founder and CEO.
Good morning.
Bob, morning. The title is The Next Frontier. And I think this is in anticipation of the largest IPO with SpaceX around the corner. And I think it also represents a lot of the opportunities going forward. And I don't know if there's anything you want to add to that since you
Yeah, if you
chose the
pull up
title.
the cover art of the presentation, obviously thematically it is really about space, right? There's so much talk about space, and why not just call it the new frontier or the next frontier? Obviously, we have Saturn and Earth, and what looks to be a big mountain, which is a data center that's powered. I mean, that's what this space thing, generally speaking, is all about. There are things like, unlimited satellite slash Wi-Fi connections. Our national defense could interact with all of this stuff, creating power on the moon. So,
Yeah.
uh, we did not dabble with any of those psychedelics in creating this. It's just a very thematic thing to talk about, and it's on the heels of a SpaceX IPO, which should be launching next week.
Yeah, absolutely.
Yeah,
And hopefully the cover doesn't look too doom and gloom because that is not going to be our case as we kind of go through the presentation today because there's a lot of consumer uncertainty and yet the markets keep going. And I think as this visual alludes to, right, there's always these bumps along the journey.
absolutely.
And we have our agenda that we have done in the past where we talk about the markets, the economy and policy, the market anomalies, and everything else. However, given that this is a mid-year outlook, we thought it would be an appropriate time to revisit our discussion in January and what we thought were the key drivers for the year ahead.
Sounds fair.
Okay, well, let's go ahead and start there. There are four thematics that we started with in January. And I know you're going to talk through this, but what you're going to see on the right are all the writing in green, which is pretty much saying that we're spot on so far. Is that fair?
Yeah, and we had an event last night, Jelena, and you had mentioned to start the year in prep for our January outlook. We had prepared well over 100 different themes that could play out throughout the year, and we really wanted to focus on maybe the top four or five. We narrowed it to four with the highest level of conviction that we thought would be immediately seen and felt throughout the markets and the economy. And it looks like we got it right here. So, just about halfway through the year, good time to talk about the four themes from January. And they were, the economy and the assistance that the big beautiful bill called OBBBA would have on moving GDP higher. And what you're seeing is that's certainly happening, and we can cover that later. The AI and power, again, fueling each other's growth. Without power, there is no AI. And of course, what we're seeing so far this year is the energy sector and AI, which is mostly tech. Some industrials are leading the markets higher. We talked about, hey, we will have a new Fed. There will be a succession plan. Someone will be nominated, voted in, approved, so on and so forth. And here we have it. Actually, starting in June this month, we will have Kevin Warsh run the next meeting as the chairman of the Federal Reserve. The baton has been passed. And we had mentioned that there would be noticeable impact from government influence and deregulation. And part of that we're already seeing is coming from IPOs, more IPOs coming to market, less red tape, more growth, just a quicker path to moving things along. And we are certainly seeing that, which again has a positive impact on GDP. So what we thought would play out, at the high level is actually playing out, and we'll get into some of those details as we go through this.
Okay, great, for sure. Thank you for going through that. And I think to kick off the market, I think a lot of our listeners are familiar with the phrase FOMO. The title here is FOMO to FEMO, which is the fabulous earnings momentum.
That's right. Yeah, FOMO, fear of missing out. We've heard that over the past handful of years. That's a momentum driven market. We sort of stopped hearing about that maybe a couple of years ago. There's a new theme, FEMO, which is fabulous earnings momentum that came from Ed Yardeni Research. I think it's wonderful because it's really earnings that are now moving markets higher. And what you see here, a lot of that earnings is certainly hidden within the information technology or tech sector and energy. What you see is a listing of all the sectors in the S&P 500, the S&P 400, and S&P 600, which is large, mid, and small cap indices. And there's consistency within those indexes. Energy and tech are leading in large, mid, and small. And all the other indexes, all the other sectors within the indices are actually participating, generally speaking, but not nearly as much as the top sectors. So why energy and why tech? Well, that's where a lot of the massive earnings growth is coming from, at least for now.
For now, exactly.
At least for now.
No, it's interesting to see that. And I love to say that the market doesn't go in a straight line. And for those of you that are feeling like, wow, it really feels like it's going in a straight line right now, it's pretty much as close as it can go.
Yeah, this is as close to a straight line as you can get. And what you see here is this is weekly winning streaks in the market going back to 1928. Double-digit weekly winning streaks, getting to 10 weeks in a row is very difficult. We're at 9. I don't think we'll get to 10. I mean, honestly, we've got a day left to do it. Who knows if we're going to get there? We shall see. But what I would tell you is whenever you have a run of 7, 8, 9, 10, 11, 12 weeks in a row, you expect a breather. We expect a break from the consistent up markets. And I think that break is really going to be the month of June. We'll see a lot more volatility. Again, part of the reason is the market has had a nice run. You have the summer months, which bring you less volume. Less volume leads to more volatility. And then it's a midterm election year. So there will be all sorts of talking points left and right, and that usually creates a little bit more volatility. So it's not a bad thing. I think it will be net neutral throughout the summer, but you're going to have ups and downs.
Sure. And I think that's a great comment leading into the next slide, which talks about having, 2-month stretches and the fact that these are one of the best ever. But then what happens after that going forward?
Yeah, well, I mean, typically you have these types of runs in bull markets, and what you see is whenever you have a 2-month cadence like this, 2-month return that we had cumulative, it usually means good things for not only the rest of the year, it usually means good things for June. I don't think that will be the case for June. This year, I could be wrong. I mean, I certainly hope it is, but I do think it'll be a good predictor of the year to come.
Okay, absolutely. Yeah. And we talk all the time about how the market lives in all-time highs. Right now, we are going through a really good extension of market all-time highs, and that's surprising to people given where consumer sentiment is.
Yeah, interesting chart. You have the month of May up top, and you have the per year number of all-time highs, within a year. And there's some clustering, consistent clustering. And really what it shows is bull market, bear market, bull market, bear market. And it really just shows that confirms we're in a bull market, and we've got some time to go. Again, the average bull market lasts about 8 years. This will be the 4th year come October of the bull market. We think there's plenty of room to run for quite some time here. We have 22 new all-time highs set this year. I would expect that to double, if not triple, by the end of the year. We shall see.
Right. And when you have these all-time highs and people are nervous as it is, the next question always comes is, well, what should I expect going forward? Is there opportunity? And I really think this slide is very interesting. It really surprises me when I look at the numbers about whether or not you should invest at a new high and what happens going forward.
You wouldn't think that this would be the case, but the best time to invest historically is at new all-time highs. I mean, logically, you would think the opposite, right? Yeah. But what ends up happening is historically, you have new all-time highs acting as, at least early on, confirmation of recovery.
Sure.
The markets are a discounting tool, right? To a degree, they're trying to predict the future and price in some of the future as best as it can.
Right.
And when you have rising markets, it is to a degree saying the future is bright, right? So then it makes a lot more sense. Then you add the time element to this, and then it makes a lot more sense because bull markets the ratio of bull markets in time to bear markets, it's like a 8 to 9 to 1 ratio.
Sure.
That makes sense?
It does. Yeah.
Yeah. So then you say, well, wait a second, the markets feel like they're bull markets make it seem like the markets are always at new all-time highs. It's because they are.
Yeah.
It's they are.
That's why
So
we live there.
yeah, exactly. So this is why a lot of these big institutions and even the people on TV that, scratch the surface when they're explaining things, they do say it's never too late to invest. You always want to get started. You always want to start investing money because you typically have up markets, and more often than not, the markets are making you all-time highs.
Right. Exactly. No, I think that this slide is fascinating. And, one of the drivers that we always talk about when we look at the fundamentals is earnings. And so one of our reasons for optimism is the continued outlook of growth of earnings, which are those dotted lines on the right-hand side of the slide.
Yeah, I mean, in a short period of time, anything can move the market. A big investor selling all their shares can move a stock down. A big investor buying a bunch of shares can move a stock price up. Rumor, politics, policy, Fed mistake, tweets, the price of oil, the yield on treasuries, anything can really move the market in a minute, a day, an hour, a week, so on and so forth. But over quarters and years, really, it's fundamentals mostly driven by earnings that moves the market, right? The direction of earnings will be the direction of the market. And what we see here is the direction of earnings is up and to the right. And not only are the direction of earnings up and to the right, we have earnings estimates set by initially the CEO and CFO of a publicly traded company. So they will come out with their outlook for the future quarter or quarters, or in some cases, the next year. And those estimates are usually pretty conservative, right? Because they don't want to set the bar too high.
Of course.
Otherwise, their stock will underperform if they don't come in line with their expectations.
Right.
So more often than not, the earnings estimates that they put out are very conservative, very low relative to what will likely happen.
Yeah.
But even then, you have an enormous increase in earnings looking out through 26 and estimated for 27. So if you have a scenario where earnings come in that way, you look at the fundamentals of the market, the price of the market based on its earnings growth, the ratio, PE ratio, shows that the market is not overvalued.
No.
If anything, if those future estimates come true, you could argue that the market is way undervalued.
Okay. Yeah,
and
absolutely.
This slide is from Goldman Sachs, and this is how they came up with their S&P 500 8,000 price target by the end of the year, which I think might even be conservative.
Okay. Reasons for optimism, right?
Absolutely.
And let's talk about this next frontier here and the looming IPO or IPOs in general.
Yeah, a sign of a healthy market is a willingness to invest. If you have a willingness to invest, investors and institutions, you have a great foundation for companies going public. We have SpaceX set to go public next week. The company is being valued just shy of $2 trillion. I mean, that's insane for a private company.
Yeah.
And again, the IPO will likely be sometime next week, probably Friday. And again, this is a company that is sending rockets into space. Sometime later this year, Anthropic, which is an AI company, they filed to go public. So certainly setting the stage for another big IPO, potentially by the end of summer.
Right.
Probably right around there. So a lot of companies are starting to go public again. That is usually what happens in a good bull market, healthy economy, very liquid economy and capital markets. So
yeah,
you don't see IPOs go public in bad environments.
For sure. Yeah. No, it's a great opportunity. And I think to your point about the price of the IPO and the value of it and looking at it and how it stacks up, it's mind-boggling.
Yeah. So because of the rise of private equity, the availability of private capital, private companies have been able to stay private longer, grow in the private markets by accumulating private capital. But at some point, these companies have to go public. Why? Well, number one, the company wants to actually borrow more money. Number one, they want to attract more investors. And ultimately, those private investors want to get their money back with growth, hopefully. So that's why typically a company will go public. You typically see over the past couple of decades, the companies that would go public, they used to be small, and then maybe 5 to 10 years ago, they started coming out as mid-sized companies. So you have some of these behemoths coming out as mega cap companies. So what we did here is there's a chart of a lot of these publicly traded companies and their total market cap. Nvidia at 5.2 trillion, Apple at 4.6 trillion, and we list SpaceX up here at 1.6 trillion. I mean, going public at that value is out of this world.
Yeah, there you go.
And then Anthropic, right, for now, and this is stale, Anthropic being valued at half a trillion. I think they will end up being closer to a trillion by the time they go through the IPO process. So just very interesting to see. It's a phenomenon that we thought would play out, that companies, when they go public, they're going to be much bigger, and here we have it.
There you go. Yeah. And you alluded earlier to a slowdown potentially as we go into the summer. And, one of the reasons you mentioned that is historically that's what happens.
Yeah, and it's slowdown of what? It's really slowdown of the rah go 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 positive, momentum in the markets. And why is that the case? Well, typically the summer months are slower from a growth standpoint.
Yeah.
Because there's less money changing hands, there's less liquidity. It is a thing where Wall Street goes on vacation. They tend to go on vacation in July and August.
Yeah.
Usually starts in June, right? And then September, everyone comes back to work. They reprogram their computers, their quants, and they start reinvesting and rebalancing, starting to do tax loss harvesting for year end. So you just have not a lot of money changing hands, June, July, August, which creates a little bit of a wider spread. Then in September, you have a lot more volume, and that volume tends to be repositioning. And then October, which sometimes is actually hit or miss, November, December, you see a lot more positivity as investors are starting to, lay out their initiatives for the next year, make the tough calls to dump some securities, to buy some securities. So again, summer months, it's really nothing to worry about. It's just market mechanics. It's just what you have nowadays. You add in the midterm election, which creates this, what is policy going to look like? What are we going to be able to do? So on and so forth.
Always accelerates the uncertainty.
You have some pricing in of the uncertainty of it all, but nothing to fear other than just a little bit of volatility.
Right, exactly. We might welcome some of these bumps, right?
Absolutely.
Well, let's transition to the economy and policy. I love this slide with the handoff from Jerome Powell as the 16th Fed chair, right?
Yep.
Over to Kevin Warsh as the 17th. The baton hasn't successfully gone to Kevin Warsh yet, but it looks like it's on the way.
Well, yeah, I mean, it is official. Kevin Warsh is the new chairman of the Federal Reserve. Jerome Powell is staying as a governor, I believe. Who knows how long he'll hang around, but he is entitled to do so. Warsh will be running the next Fed meeting, which is about 10 days from now. So the succession plan has happened. The baton has been passed.
Well, I just meant in terms of the success of what Kevin's going to do, but yes.
Yes. Well, we don't exactly know what he's going to do yet.
Exactly. But we are going to chat a little bit about that here in a second. But I think before we do that, understanding the Fed's makeup, I think this is a great time to always revisit what that looks like.
Yeah, there's a lot of diversification amongst the Fed. The Fed is independent, remains independent. If anything, my opinion is it will become even more independent. If you listen to anything Warsh says, he wants more open debate. He wants more dissenting. He wants to get everything right, and he wants everyone to participate. It's okay to disagree. The past couple of Fed chairs have, behind closed doors, allowed everyone to dissent and voice their opinion. But when they go public with their statement, it is more of a coming together. Whoever the Fed chair was in the past, they really wanted buy-in with their decision. Warsh does not want that. He wants disagreement. He wants a scenario where everyone is free to voice their opinion. You can go public with it. That's completely fine. Here's the decision that we end up voting on, and this is what we're going to do. So I think anyone worried about the Fed independence should not be worried at all. And when you look at the makeup of the Fed, some of the rotating members, the fact that things change slowly at the Fed, I think we'll be in good hands. And I think the independence of the Fed will not change. If anything, it will get stronger, in my opinion.
Okay. Yeah. And it's interesting to me also that another observation when you look at each Fed chair going all the way back to Greenspan is everyone looks at the Fed word count, right? And the volatility that it may create.
Right. So if you over articulate, one of the weapons or the tools that the Fed has is the words, right? They can put into place a narrative and get the capital markets and economy to pay attention and adhere. But oftentimes, if you're too wordy and you talk too much and you give way too much information and way too much forward guidance, the market and economy expects that. So then once you hand that leash, that long narrative, once you play it out into the future, that really sets the expectation. And the markets are powerful. They can maybe force your hand a little bit. And again, that's not the position the Fed should be in. So I think what ends up happening here is we're going to go back to the Greenspan days. If you look on the left side of that chart and the word count, which is tracked in green, I think we're going to have a much less vocal, wordy Fed, which I think over time, not initially, will make the market react less to the Fed. Initially, that won't be the case because there's change. But I think over time, if the new expectation is don't expect me to over articulate for 3 hours and then talk about 28, 29, 30, 31, what the Fed might do, what we're going to do. We don't even have the data. It hasn't happened yet.
Yeah.
I think that puts the capital markets more in check, and the capital markets should pay more attention to fundamentals and earnings and employment data, the stuff that really should be focused on, not the facial expressions of the Fed or the narrative that they're trying to portray post meeting. Does that make sense?
Oh yeah, we love to overanalyze everything that they
Correct.
do and absolutely.
Correct. I think it just you had a scenario where you had the financial crisis and there was some security or better feelings in having a Fed that was over articulating everything. That baton was passed from Bernanke to Yellen. Yellen, was part of the Fed with Bernanke, so she just kind of continued on that path. Yeah. However, she was certainly more of an introvert, so the word count went down, and then Powell came in and continued on that downward path. But then COVID happened, and then you needed reassurance from the Fed. So then Powell was sort of forced into very long meetings, very long press conferences, over articulating everything, repeating himself many times.
Sure.
I think with Warsh, at least what he's saying now is there's not as much that I want to present to people. We shouldn't be talking as much. We should be really just focusing on the things that we can control in our job and let the capital markets focus on data and all the other stuff. Let them come to their conclusions.
Okay.
So we'll see how it plays out, but I think we should all expect a quieter Fed.
Yep. The media will find something else to focus on.
Correct.
And as we've talked about in past webinars, talking about, the fact that the Fed may be pausing here for a little while, we should talk about what that expectation looks like now.
Yeah, I mean, you have elevated inflation because of the war, right? Because of the spot price of oil and its influence on some of the other items, mainly. You have housing cooling, though, which is about 40% of inflation. So you have some cooling forces, some forces that are warming up in inflation. And ultimately what you see here, the odds of anything are low, both on the cut side and the hike side, this sets itself up for a pause. And what we think will happen, Julina, we've talked about this. You have the relative deflationary effects of tariffs, right? Because we're not really talking much about tariffs anymore. That will be hitting on top of some type of resolution coming with Iran soon. And I say soon, that means potentially not so soon, but maybe 3 months. And then you're already starting to see the spot price of oil, which was at 115, is now down to the low 90s. I think that trend will be lower. So, it doesn't make sense to change monetary policy for 1 quarter of slightly higher inflation when that could pivot very quickly to lower. So then what do? Do you get into a scenario where you're tinking with short-term interest rates? Probably something that the Fed doesn't want to do.
And you're leading into the next slide in terms of how they may be looking at inflation going
So
forward.
then the Fed, this Fed, and specifically Kevin Warsh, has always been a fan of a different measurement of inflation, regardless of if it's low or high. He likes to look at and refer to trimmed inflation. Trimmed is, just briefly, you take all the data points and you take the outliers, the stuff that is way down and way up for the month, and you take that out of the measurement, knowing that those, when they mean revert, anything that's really hot will turn cold pretty quickly. Anything that's really cold will mean revert, go back the other way. So take those out. We don't want those to influence short-term policy. Right. So when you take out the extreme edges, the ups and downs, and you focus on the middle,
correct,
you actually have a lower level of inflation.
Yeah.
So right now the Fed measures something called PCE, which is really personal consumption expenditures. It's really what we spend money on versus the overarching CPI, which is a list of everything. I think coming soon, you're going to hear more about something called trimmed inflation, which is all of the data points, pull out the hot and cold stuff, recast it, and that's our inflation rate.
Yeah, and as you can see from the calculation on the slide, the dark green is the core PCE, which is at that higher level, and that trimmed is more subtly below, it's below that.
Yeah, and there are times where the trimmed actually tracks higher. There are times where it tracks lower, and right now you have a scenario where it's tracking lower.
Lower, exactly. Yeah. And you mentioned inflation with tariffs. So let's talk about how that's cooling.
Yeah, again, another interesting slide from Goldman Sachs. Their forecast is for lower inflation second half of the year, and the rationale is the energy effect, while it added to inflation over the past 2 or 3 months, it will likely detract as the spot price of oil cools off. And then you also have the tariff effect. So they've got it, taking, almost a half a point to a full point off of inflation in the second half of this year into 2027.
It's interesting to see the tariff is the dark blue and how quickly that came down. And was replaced by oil with the initiation of the war, but that is also coming down. So I think that's why people are still having these inflation concerns.
Correct.
So, okay. Let's talk about AI and the benefits of OBBBA.
Yeah, so really this is through the lens of the economy. You have a lot of economists, the blue chip forecasters, right? Down bottom, and their forecast tends to always be wrong. They tend to set a low bar for economic growth. You have an entity that is incredibly accurate, and that is the Atlanta Fed. They just measure differently. We should only pay attention to the Atlanta Fed's estimate for GDP growth because they are wildly accurate. The forecasters are forecasting just about 2% economic growth, and where economic growth is coming in is closer to 4.5 to 5. So it just shows you on this chart that the Atlanta Fed gets it right. Where is the economic growth, outsized economic growth coming from? What's the benefits of AI adoption and productivity? Productivity drives the economy higher, right? And the tax and spending bill. So all of the activity that's being promoted through this bill to grow things, build things, expand, certainly in the US,
right.
Those two together have created an outsized level of growth for the economy, which we think will hang around for some time.
Right. And again, this was one of our key drivers in our January webinar.
That's right.
And we have shown this before, but this was updated as of the end of May. We commented about how low consumer sentiment is. It's the lowest ever.
I don't think sentiment is going to rise to a level that we've seen over maybe the past decade or so.
Sure.
Um, I think part of that is this isn't just economic stuff. People are sour for various reasons, right? Whether it be what they're hearing on TV, what they're hearing from their family, the cost of everything, depending on who you ask. And I think it's always easy to be negative. It's harder to be positive and optimistic, especially if you have a crowd around you. You don't want to be the outlier,
Right.
right? That's one. Number two, it's just ironic that we're at all-time highs. The economy is growing above trend. We have full employment. Interest rates are one third of what they were 3 years ago.
Right.
Right? The second lowest level of consumer confidence was when inflation was 9.2% in 2022,
Right.
which is that closest to the right red circle.
Yeah.
So right now, consumer confidence is a little bit lower than that. I think from here, confidence will come up a little bit. But again, where does it go? Slightly higher than where it is now.
Yeah.
From this, our takeaway is this is the ultimate contrarian indicator.
Exactly.
You always want to invest when sentiment is low because the reality is something very different.
Yeah, we have shown historically a slide where when consumer sentiment's at an all-time low, the performance of the market going forward is significantly better
It doesn't get
than
any better.
when consumer sentiment's at an all-time high.
Yeah,
Exactly.
because you can almost replace this with expectations as well.
Sure.
So expectations and sentiment is so low,
Yeah.
it's so much easier to jump over the bar.
Yep.
Does that make sense?
Absolutely.
Yeah.
Yeah.
So
And this is a very interesting slide because I think a lot of us are talking about how we feel like everyone's moving around, and we're in the Northeast. We talk a lot about, how people are moving south. My sister lives in South Carolina and she's talking about how the growth down there is just unbelievable.
yeah, I mean we're seeing it. And actually on this chart, so hard to see, but on this chart, looks like South Carolina has the fastest per capita growth in the country.
It
And
does.
we look to try to glue it together, we put sort of tax policy, state tax policy on the right. So
Right.
you kind of mentally overlay it yourself.
Sure.
And people are fleeing from, New York, New England, Massachusetts, California, and they're running to the Carolinas, really the South, Texas, so on and so forth, Maine even. And for us, a lot of it ends up. We have tons of conversations with people that are doing this. A lot of it ends up being tax policy.
Okay. Sure.
Yeah, it's the metro areas. California is incredibly expensive
Yeah.
to live in. New York, New York City, New Jersey, New England, Massachusetts, very high tax states,
Sure.
very expensive states to live in, and where people are going tends to be the opposite,
Yeah. She
right?
loves to remind me what her tax bill is.
Yeah. So there's the migration chart on the left,
Right.
and then there is separately this tax chart on the right. And
Yeah.
if you were to overlay them, you would see that there's a lot of consistency. We just thought we would show everybody this.
Yeah. It makes a ton of sense. The visual is very intriguing, though. And let's move on to market anomalies. And we're going to start with what's called Welcome to the Club, the trillion-dollar companies.
So, Julina, it was not that long ago, maybe a year and a half ago, maybe 2 years ago, when Apple and Microsoft became the two companies that reached $1 trillion market
That
cap,
crossed over. Yeah.
right? Which was just an amazing level. And everyone was fearing that, well, there must be something to that level, meaning it's a top, right?
Doesn't
Well,
look like
no, I
it.
mean, you know, all of these companies used to be $100 million companies. Then they became $1 billion companies, $10 billion companies, $100 billion companies. Now you have a trillion. It's just as anything gets bigger,
Right.
right? It just continues to grow. I mean, homes were $25,000, right around when I was born. And now that same $25,000 house is, $1.8 million.
Right.
So it's like anything, the cost of stamps, right? So But in this case, you have publicly traded companies that are earning money, growing, becoming foundational elements of the economy, our daily lives, so on and so forth. So now there are, according to this, $14 trillion publicly traded companies. Most of them are in the US. And some of the new members are Micron, SK Hynix, and Samsung, most recently from a slight run up in the need for memory
Sure.
due to AI. But again, the trillions are becoming more common. So for fun, on the left, we listed out what comes after trillions. Well, you have quadrillion. Just a lot of commas and a lot of zeros, Julina.
Holy cow. Yeah.
Yeah, yeah, yeah. And
Well,
look,
I mean, Nvidia's already crossed 5 trillion.
that's right.
So we
Next
are
stop
talking
is
about
10,
quadrillion.
and then 100, and then before you know it.
Yep.
So
Okay.
more to come.
And as we're talking about these extreme numbers, why don't we expand and talk a little bit about space?
Sure. So space, there's an opportunity in space, and it likely comes from the angle of connectivity,
Hmm?
defense, shockingly, power,
Okay.
storage. That one will be a little bizarre for most people.
Okay.
Uh, but there's a reason why Elon Musk and SpaceX and Jeff Bezos with Blue Origin and others have been going to space,
Right.
because that is where the keys to future global defense and national defense lie, and connectivity lie, and the ability to potentially store data,
Okay.
potentially energy. If you think of the climate on the moon, right, it has some cooling elements to it. So again, you have a lot of satellites up in space. I mean, at some point, there's going to be traffic like I-95 in space, right? So with the amount of rockets and satellites and things and data
Yeah.
centers, eventually it will be wild for all of us to think of it as it plays out, but there's something to it.
Well, it's also interesting to look at the history, right? And you go back all the way, and I think a lot of people listening can remember going back to the 60s into the 70s and 80s and how there was a lot of dominance from Russia.
Yeah,
And then, the US kind of really stepped in the 80s, and we have the end of the space shuttle program in the 2010, is that right?
that's right.
And now you see this sort of liftoff again with SpaceX and some of the others. It's fascinating to see.
Yeah, more to come.
More more to come. And I like this. Can you hear me now?
Yeah, so you look at satellite bandwidth costs and cellular data. Really, the best thing to look at is the right-hand chart. And you go back to 2001, the monthly plan for someone's cell phone was about $90 a month. It included very little data, but you had the capability of email and basic web searching. And
Yeah.
the amount of coverage, US land coverage, was about 1%. This is in 2001. Fast forward to 2025, you have about 86% of the land covered currently. Shockingly, there's still 14% of the land not covered. You currently have unlimited high-speed internet. You have unlimited data, but the price of the plan has gone up.
Yeah.
You combine cell service with satellite service, keeps the price the same in the future. You have unlimited data, and you get more coverage, in essence, of the planet, never mind US land coverage.
Right.
So there's something to this.
Something to it. And the first time we saw this slide, the first thing I thought of looking at that 86% is, well, that's the merit. That is the pockets of the merit in Southern Connecticut.
That's right.
That
Yes.
still don't
Right.
have coverage.
It's a very good point.
Yeah. So
Yes.
one other slide on space, which is also interesting in regards to Blue Origin.
So just Jeff Bezos was on CNBC about 2 weeks ago. Fascinating interview. So what you have here is Jeff Bezos holding up a lunar solar cell made from moon dust. So again, these are very far out things, but there's something to it. They're not just blowing money going to the moon, going into space. This will be very likely critical to our infrastructure, potentially the world's infrastructure, certainly the US, our national defense, data storage, keeping the cost down. There's a lot going on, and there's a reason why these people are doing it. So
Amazing.
yeah.
I can't keep up with this. As you know, I couldn't even get my web browser going this morning.
Well, Julian, at some point there's a point in our lives where we just say we're too old for this stuff. And I think you and I are,
You're throwing me in that camp.
we're holding hands on this one.
There you go.
We're in the same
I'm
camp and we're
always kidding.
saying this stuff is too far out for us.
It's too far out. It's yeah,
Yeah.
I guess I'm there. So
Yeah.
yeah. Well, anyway, I think the last slide we wanted to share is talking more about how we spend our time since we're talking about our age.
Yeah, we've shown an iteration of this in the past, but we really want everyone to, you have your investments, we're managing them. We're always going to give it our all for you. And hopefully the great output and great returns that you've seen will continue to be the same for forever. Fingers crossed. However, you really should focus more on another resource that you will never get more of, and that is your time. And we just want to remind you that you should be investing and spending your time wisely. Two little charts here. One on the top left is who we spend our time with by age. And what you see on the top left is that dark blue bar that almost looks black. That is time spent alone, minutes per day. It only rises over time.
As we get older, you mean?
Yeah, time spent with friends and family, parents, partners, coworkers, that all declines.
Right.
Time spent alone rises. So make sure you're spending your time wisely. On the bottom right, we show how people spend their time. And in hours, there's a lot of wasteful time, more and more so over the past 5 and 10 years, showing up in that category.
Yes.
So, spend your time wisely, invest your time wisely, invest in your health.
Yeah, because that's the lowest one in terms of time.
Yeah, if you invest in your health, you may end up with more time, shockingly. So,
Right. Absolutely.
with all the stuff that's going on, all the headlines, the politics, the spin, the stirring of the pot, be positive, spend your time doing good things with good people, and enjoying your life.
I think this was a good time to share the slide as we are going into the summer months, and the hope is that, things slow down. We know the markets are going to slow down, and kids are coming home from college or coming home from school, grandkids.
Yeah.
And so we hope you're thoughtful about how you spend your time this summer, and we hope that everyone enjoys the summer.
And
So,
don't forget your sunscreen.
and don't forget your sunscreen.
So we'll be back in a month to give you an update uh, through the month of June and early July.
Yep, we're not taking the
Uh,
whole summer off. We will be
yeah,
back.
yeah, yeah. Hopefully, if we applied sunscreen properly, we won't be sunburnt. We'll have a slight tan, and we'll see you then.
Yeah, we will see you then. And thank you, Bob, as always, for your insight and for everyone that's listening. We appreciate your time. If you have any questions, concerns, please reach out to any of us at Principal Wealth, and we'll circle back in July.
See you soon.